starting. Lots to digest. There's lots of things kind of happening in the market already, mainly to do with the dollar, which is hi Helen, hi Gary, hi guys. Happy New Year to all of you. Yeah, really interesting things going on to do with the dollar. So where I think we should start is kind of considering where things could go and really the price. I mean, that's what we're trying to kind of ascertain here. Whether trends are going to continue, whether they're going to start to reverse. I have to say that some of the situations certainly suggest that we are at extreme territory. So, whether things do sort of like start to turn around is going to be the question, isn't it? So let's start with the economic calendar of the week, because this is going to shape our decisions this week. And of course, obviously, if you guys have got any comments or questions, then just bring them in, because now why can't I? There we go. Yeah, bring them in, because everything's valid. Anything that we discuss is going to be sort of valid for us to talk about. Now, the big days. I've had a look through the economic calendar. Now, the COT data, unfortunately, is not going to be released until tomorrow. There was a celebration or a memorial service, I should say, for the passing of Jimmy Carter, the previous president, and that has pushed everything back a day. So we're not going to get this week's COT data. You can see Monday here, Monday, January the 13th, which is tomorrow. That's not good, and this is the COT data here, the CFTC. So we get it from the Nasdaq, we get it from silver, soybean, and what we're interested in is the currencies. And we can see CAD, Swissy, Aussie yen, Kiwi euro, and the dollar being there somewhere as well. They're not going to get released until tomorrow. So we can make some choices and decisions, but we've got to be aware that when those numbers come out, then we might need to flip what we're thinking. There's nothing fundamentally released on Monday for us to make any decisions on the week. It starts to pick up a little bit on Tuesday. See some inflation data in the form of PPI from both Switzerland and from the United States, with some ZEW economic sentiment as well from the Eurozone. So that's something that we need to keep an eye on. M2 and M3 money stock and the Westpac consumer sentiment. These are all numbers that we should take into our spreadsheets, really, and see if we can analyze where the economy's going. But if we're talking about the movements of the week, it really starts on Wednesday. CPI data from the United Kingdom. Now, 2.6% is the prediction, and that's the same as last time. Now, if you open a CPI calendar and have a look through it, you can make a prediction on where you think the year-on-year number is going to go. And the way you do that is because we're in January 2025, you would go back to the February number. So if you think 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and this is going to be the 12th number. So if you look back at, if you add all these numbers together, in fact, we'll show one more because we need January. Now, 4% was the previous January number, last January. Now that number is going to be replaced by this year's number. So if we were to add up what we have from February, so we got 4 plus another 4 for March, plus 3.2 for April, plus 2.3 for May. So it started to come down. May 2024, 2.3. June was 2. July was 2. August was 2.2. September 2.2. October was 1.7. November 2.3. And December 2.6. Now that brings it out to around about 28. Well, brings it out 28.5. Now, if we divide that by 11, we get 2.5, 2.5, 2.6. So what that's basically telling us is anything above 2.6 is going to push the number higher. Anything below is going to push the number below the 2.6 prediction, the forecast. Now, if the last number was 2.6, if the previous inflation print was 2.6, and we've been building from 2% to 2.2, 1.7 was a big dip, but then we started to build again. So we've been building the last few months. I think we can assume that the inflation narrative is actually picking up. So I think this forecast might well be actually off. Now that's going to be, it's a complete speculation, and you can make your own kind of predictions on top of that. The 4% is going to get deleted from this number here. And if you were to add 4% into what that inflation was as well, so if we times it by 11 again, just to get what the, and then add 4%, divide that by 12, that gives us a 2.7. So actually, anything below 4% is probably going to bring it down 2.6 and below. Looking at this, so actually, this number might get beat. This number might get beat. So remember, we're looking at the previous January number. We're adding it into the equation and seeing what it would be, and then we're going to sort of say, is that likely to be, if it's 4 again, then that gives us the 2.7% inflation on January the 16th. But anything below that, now if we let's do it to 3. So we're going to minus 4, and we're going to add 3. Divide that by 12. That gets us to 2.6. I reckon it's going to be in and around. I don't think this is going to be too far off. So anything 3 and above kind of pushes this to 2. It's around about 2.6. If you added decimal points, it's going to be slightly higher than that. So I think this is going to be in line with expectation. That would be my prediction. Anything below is going to need to get below 2.5 really to push this number under the 2.5. It could, but it's going to be in and around this number. I don't think it's going to be too far away. So that's the first thing. Now, if you want to go straight on to analyzing charts of the pound, considering this number, you can obviously do that. Now, if I was doing that, I would probably have a look at the pound Swissy. Sorry, the pound CAD. And the reason I'd look at the pound CAD is because the pound CAD is right on top of, and there's a few of these that are on top of support and resistance, but this one's right on top of it. So if you look here, it's not far away. It looks like a little push to the downside could still be in, but it doesn't look like there's that much room. If this comes down before that number, I would expect a bounce after such a huge sell-off, or it might be that we get the bounce early doors, but I would look for sort of buy signals with this because it's so close to its trend line. If it came down to the trend line, there doesn't look to be, because if you think about it, what's the reason that we get these types of bars? And what's the reason that we break support and resistance? Look at that strong bar there, the break of previous resistance. And the reason is because of a fundamental data point. Now, CPI data is a fundamental data point that could drive this market. So if CPI comes in under probably 2.5, but 2.6 might be enough. If it comes in under, then you'd expect a break of the trend line. If it comes in above, you'd expect a bounce. Sorry, if it comes in on or above, you'd expect a bounce. So that's the kind of thing that I'd be prepared for. Looking for that number, seeing where we are. The bounce is more attractive because the breakthrough is not often the best time to sell. it's better to sell really on a retracement. So that particular trade, unless you're a breakout trader, that particular trade might not be quite as safe and not quite as easy. It's still valid, but it might not be quite as easy. So if the number is way below 2.6, so let's say it comes in at 2.3, a breakout trade would be great. If it comes in at 2.5, breakout trade might be just that little bit more difficult. So look at the number and try and make an assumption on whether there's going to be a setup that is worth taking and palatable for you. That's the way I'm kind of reading it. Oh, did I? Yeah. So let's go back to the economic data. Now, on the economic data here, Wednesday is kind of a big day for inflation in general because then you got the dollar and even that pound CAD might not move until this is released. So numbers from Canada is you know they're not really kind of like market moving numbers. Wholesale is given 2 stars, but I wouldn't really be that concerned with that. But obviously CPI data from the United States is big. Now CPI data from the United States, again, we can kind of do the same thing, the year on year, and I'll show you sort of how I'm doing this actually. Let me bring this in so you can see it. Now, if you can't see my screen, do let me know. But hopefully, if I do this, you can see both screens. You can see the calculator. If you can't see the calculator, let me know. Okay, so we're going to do the same thing. We're going to go back to January, and we're going to add that in. Okay, so if we go 3.4 and 3.1. So all I'm doing is I'm adding January, February's number, then I'm going to March, which is 3.2 plus 3.2 plus 3.5 3.4, 3.3, 3.4 plus 3.3 plus 3 point plus 3 plus 2.9 plus 2.5 plus 2.4 plus 2.6 plus 2.7. 36, we're going to divide that by 12, which is obviously going to give us 3. And if we look at that, that means that this number here, 3.4, if we were to say that this number is going to be below 3.4, so if we get rid of this number now, so we're going to times it by 12, and we're going to minus the 3.4, and replace it. Now, if we look at it sort of over the course of this year, sorry, last year, the number looks like it's around about 3 to 3.5%, you know. So the last two numbers were 2.4, 2.6, 2.7. So the mean of that, the kind of, or in fact, if we go from the 2.5, you can see that the average there is going to be around about 2.5, 2.6. But if we go with a higher number and add the 2.7, so we're going to add 2.7. So we're going to assume that this number is going to come in just a little bit lower. And we divide that by 12. So we've replaced 3.4 by 2.7. We get 2.9. That's what they're predicting. They're predicting 2.9. So the number would have to come in, the inflation would have had to dip below last month's inflation for that to dip. And even then, it would have to dip quite a long way. So it looks like this forecast is going to be pretty close to in line. Now, if this number is higher, that doesn't help any dollar bears, but that doesn't look like we're going to get much change, because if you think about it as well, 3.4 is not that, it's high, but it's not crazy high. When we were kind of looking at some of these numbers, so if you were sort of omitting the March 23 number and looking at March 24 number, there was obviously going to be a big drop because you're taking this number away. So when you do your calculations, you're kind of looking at more like the 3. So there's obviously going to be these huge drops kind of from this point onwards, because we were involving these higher numbers in calculation. But 3.4, if you look at it, on a general term, it's not that high. It's quite high, but it's not that high. So 2.9 looks like it might well be in line with expectation. That doesn't really help out the dollar bears. Not quite sure what it'll do to the dollar bulls. What else could there be to move the market? Let's have a look. GDP from the United Kingdom, that might well move the needle, and GDP moving the needle could be significant because the UK economy is considered to be under a little bit of stress. So if this GDP number is a beat, then we could see the pound rally. If it's a miss, will it come down a lot? Well, it depends. It is expected. Then we get some job numbers from the United States as well. This is obviously like to move the needle. So really what this is basically suggesting is Wednesday may not be a great day to trade. Even though we got big numbers, those numbers look like they may well come in line with expectations. So it might not be a great day to trade. You have to watch them, because if they do miss those numbers, then there's going to be some volatility. There's going to be some market movement, and see where it's missed it. Particularly the dollar. If the dollar is below 2.9, then there's likely to be a big sell-off on the dollar, and we'll have plenty of time to take advantage of that. And we'll have a look at why that might be the case in a moment. But coming in under 2.9 could be significant. Then we get, as I say, the jobs numbers, and then eventually we get on Friday the inflation data from the euro. Now I won't do the calculation again because you guys are getting the picture. But that's core. I don't want core. I want CPI year on year. Where is it? Here we go. I know. Oh, they're not listing the year on year. Why aren't they listing the year on year? Maybe go to Forex Factory. This looks like a little bit of a mistake in their recording, but you get the idea of how to do it. So have a look at that. 2.7%, 0.5%, 0.4%. These all look sort of relatively calmish. They look like they could be in line. So I'm not sure if we're going to get much of a movement out of these particular numbers. There may well be something else, but we might not get the movement out of those numbers. Now let's just have a talk about how that could reflect the charts. So if we go to the charts and go to the price action, what that is kind of suggesting is that we may get lower volatility this week, because those numbers are likely to be in line with expectation. Of course, likely doesn't mean it's going to happen, but they're likely to be in line, which means that things that are near or on their trend line are more likely to get a bounce. Now, where this is important is that if you look at things like the Kiwi dollar is right on top of a double bottom, and that was back in August 2022. So we're looking at 2.5 years later, 2.5 years later, we're back down to this number again. That suggests that the likelihood at the start of the week is that we get a rally of some sort. So there might not be lots on offer here, but just some trade ideas. What would I be looking to do? Well, I'd be looking to try and trade this up. I'd be trying to look to try and trade the contrarian position here, because those numbers aren't particularly significant. Those numbers may well not be significant. You see CPI data coming out on Wednesday, and it's in line with expectation. it's unlikely to change the trend, but a counter trend trade on an intraday basis that might be of interest. Obviously, we need to see some buy signals, but that could be of interest. There may well be a little bit lower for it to come first. Of course, going against the trend is dangerous. We're looking at weekly charts here, by the way. Going at against the trend is dangerous. So you need to be very careful. But a little short-term bounce could be of interest. You know, coming right down to the lower term time frames here. Probably looking at the hourly to kind of get above 55, 56, something like that, you know, 55, 90, 56. If it can break through there, then there may well be even a break of this level here, but there might not be that much to the upside. So we're going to have to be kind of careful how we play it. But I'd be interested to see whether there's you know, maybe a short-term bounce here. Now, if we then bring in the other factors like COT data and seasonality, I can tell you that the seasonality is suggesting that this week is going to be particularly negative for the Kiwi. So because of that, that would probably keep me away. So even though my idea initially is, okay, these numbers aren't going to move the needle, so a bounce might be in order. Now I bring in seasonality and I say, okay, just stay out, just stay away from it, because you know, even though that there may well be a bounce, the Kiwi is due to be the weakest currency of the week. And it doesn't really change that much for it over the month either. So it's coming into a very weak period. That makes it difficult to trade, you know, because we are so low in the Kiwi dollar. It's so negative down here. It would be you know, difficult to kind of love that one. Now looking at COT data, kind of bringing that in. If you bring the COT data in and have a look at the Kiwi tends to react you know, tends to have the highest correlation with asset manager positions short, and when they go short, the Kiwi tends to collapse. Now look where they are. You know, they are at extreme. They are short in the Kiwi, heavy, which is reflected on the chart. And if you look at where this turn was, this low here is September 2007. Sorry, September the 17th, 2024. And if you look at this move here, this is September the 22nd. The high was created right on the turning point here. And they've just been selling, heavily selling. And if you look at the last time this happened, so this was the last trough here. That was July, which is here, and it sold off. So we're looking at when this goes up, the price comes down. This goes up in July, price comes down. So, you know, we can trust these guys. Price comes down here. The time it happened before that was here. That was in February, end of February 2024, which is here. Is that right? Yeah, this is February, last time it came down. So we can trust these guys. Now, this to me looks dangerous. Very, very dangerous, because we're not down here, we're up here. So they might be heavy selling. And for starters, we haven't got this week's COT data, so that's got to come out tomorrow. So my advice is look for the asset manager position short and see where they are going. If they have increased again, that does suggest further downside for the Kiwi, and that would be in line with seasonals. If they have increased, sorry, if they have decreased, there may well be a short-term bounce that we can take. So what you'd be doing is going here. Hopefully you can see my screen here. You go into CFTC, commodity and futures, and you're going to the commitment of traders. So you've gone to the CFTC. which is cftc.gov. You go into commitment of traders, and you are going to go and check out this. And you are interested in the current traders in financial futures reports and trading in financial futures and options combined, and the long format. So when you see here, this is the Canadian dollar. So we're going to go all the way down to the Kiwi, which is here. And you're looking at the asset managers, which is the second group, and you're looking at the shorts and seeing whether. So you might want to take a note of this number, but you can see that it tells you changes from the previous week to December 24. There was an increase of 1,000. So this is the number you're interested in. Are they increasing or decreasing? If they decrease, it suggests there could be a rally. If they increase, it suggests that there could be further downside for the Kiwi. So read this number tomorrow night before taking any positions if you want to do the counter trend trade. If you don't, then obviously, ignore it. So so that's really sort of what I would offer today. I'm going to tell you that across the board, weak currencies this week. So you might want to make a note of this. Weak currencies this week on in accordance of seasonality are the Aussie, the Kiwi is weak. The CAD is also weak this week, which could bring that pound CAD bounce into play. The pound is not particularly strong, but it's stronger than the CAD this week. The strongest currency of the week tends to be the Swissy. Kind of it's created the most profits, but it only tends to rally 40% of the time. But the dollar tends to rally on this week around about 65% of the time. So the dollar is strong, but it's the least attractive, and it's purely the least attractive because of where price is. I mean, you could go right along the dollar and have a look. Aussie dollar, it's just these are weekly charts. You look at these on a monthly monthly basis. We're right near these lows again. So just not an attractive proposition at all. The the Kiwi is interesting. So because the Kiwis not the Kiwi, sorry, the Swissy is interesting because the Swissy does tend to have some strength this week. If you're going to go short the dollar, the Swissy may well be one to try and play it against, and you can see why. Triple top, W bottoming pattern, of course, but it's got to get through these areas. So there might be some retracement here as well. So I'm looking to fade the rally for the dollar, but it's going to be a tricky trade. So you're going to need to be right on top of your game if you're going to try that kind of thing. You're not trend trading. Trend trading this week looks to me to be a little bit exhausted because of where the dollar sits. Now, of course, the other option is just don't play. I'm quite happy to sit out if I don't see what I need to see. So that's the market update. Now, have you guys got any questions? Is that confusing? Is it all okay? I mean, I'm just telling you my particular approach. I'm certainly sort of if we go back to the charts, you should be able to see that the dollar is at an extreme. Whether it's overcooked, we just don't know. Fundamental data continues to push for higher dollar, but we do have a president coming in. When's he coming in? Next week, not next week, the following week. I think the 20th of January, he's due to be inaugurated. So we've not got long, and there might well be some people that are quite happy to position for weaker dollar because Donald Trump will want a weaker dollar because he's all about trade. So the dollar move could be near its end. And that's the most interesting to me. That's the most interesting trade, that the dollar rally could be near its end. And I'll be looking to try and play that. And the evidence, as I say, if you look at COT data, you look at, all this kind of stuff, it shows that the dollar's at extremes. But the seasonals are actually pretty good for the dollar for the next month. Okay, so any questions, guys, or you guys are all okay? As I say, it's not mandatory to take trades. You can certainly sit out until the picture becomes clearer. This is just about, in the end, it's about making money. It doesn't matter when, doesn't matter how much, it doesn't matter how much. It's about making money ultimately. So just about doing the right thing. So trade well, and have a great week.